everybody? It's Tortoise Investing coming at you today with 5 dividend stocks that you can buy and hold forever. Some of these are down off their recent highs, and I think they might be great buying opportunities. Not financial advice. Always do your own research and stuff before buying anything. Before we dive into anything and everything, if you could please subscribe if you haven't, hit that like button, and comment down below. Let me know what you've been looking into, what you've been buying. These 3 things, super simple, super easy doing. It helps the channel out a ton. Before we dive into the 5 stocks, though, just want to quickly show off my portfolio. I'm never going to hide this from you. It's going to be showing it live, ups, downs, all arounds. So we are setting at 15.3% up on the year. The S&P 500 is up 11.09%. So we are still beating it. We'll take a look at the holdings tab here. A lot of my positions are down, but you know what? I'm just going to buy more. I'm going to be adding to some of these tomorrow and try and get my overall dollar average price down on them. I like my holdings. I like all of these, and there are a lot of other stocks that went on sale that I like a lot too. Now let's take a look at those. Lockheed Martin. If you've seen my past videos, you're going to see this show up. I love this company. Below 400? What? This thing recently cracked the 500 mark back in April, down to $3.99. Adjusted free cash flow yield of 5.7%, dividend yield 2.9%, payout ratio 43%. Take a look at the revenue growth, 5.27% over the last 5 years. Free cash flow 25.77% over the last 10 years. Look at that. That is awesome. EPS right at 10% over the last 10 years. Debt, they have $15.4 billion in debt. Their EBITDA is $8.7 billion. My rule of thumb, what I personally like to do, I don't like companies that have 3 times their EBITDA in debt. I feel like that kind of things get a little bit ahead of them. There are some companies that are so moat heavy and just so good at what they do that you can make an exception for them. But most of the time, this is a metric that I look for. I like companies that have great financial balance sheets, and Lockheed Martin is definitely one of those. Over the last 10 years, increasing the dividend at a rate of 10%. Again, very nice. Shares outstanding. They've been buying back shares aggressively as of late. Over the last 2 years, 3%. And over the last 1 year, 4.6%. Just shopping at that share count means you get a bigger and bigger piece of the pie. Love it. Return on capital employed has been reliably above 20% since 2018. And if you take a look here, their gross margins above 10%, operating margins above 10%, profit margins slowly dropping, but still pretty good. They know how to make money, and they keep winning contracts. They just recently won a huge one. Yeah, $1.2 billion U.S. Navy contract. These are the go-to for America when they want some defense things made or built. Next up, we got MasterCard. I really like MasterCard. This is a holding that I have as well. They have an adjusted free cash flow yield of 2.71%, a low dividend yield of 0.58%, but they do huge dividend hikes. Payout ratio 20.6%. Let's take a look at the revenue. Revenue's been increased at a rate of 11.64% over the last 10 years. Free cash flow 13.97% over the last 10 years. Their debt $13.7 billion. Their EBITDA is $13.3 billion. No issue there whatsoever. EPS 16.65% growth over the last 10 years. Now that dividend, 25.25% increase over the last 10 years. Look at that. It literally looks like a set of stairs. This is compounding at its finest. Shares outstanding. They usually buy back shares because they don't know what else to do with the capital. Over the last 10 years, I rated 2.56%. So again, getting a bigger and bigger piece of the pie. When it comes to their return on capital employed, it's just ridiculous. It's right at 50%. Their gross margins, 70% plus. Operating margins above 50%, and their profit margins are above 40%. This is just crazy. I love this company long term. I am very long them and very long Visa as well. Now, you might be thinking, oh, it's off its recent high, but not that much. This company's been trading around this area for a while. It's touched to 400 a couple of times. It hasn't broke out. And I think when we do hit that next bull market, it's going to break out. I am just going to be adding while I can. Next up, got S&P Global. Adjusted free cash flow yield 2.63%, dividend yield 1.01%, and payout ratio 48.5% off the recent high of $427 down to $358. They are in a slow free fall. Revenue has been increasing at a rate of 9.6% over the last 10 years, but it's been accelerating, as you can see. Free cash flow 14.48% over the last 10 years. Very nice. EPS 20.8% over the last 10 years. It's up and to the right. Debt $10.7 billion. Their EBITDA is 4.13. Again, no issues there, my personal opinion. Dividend has been increasing at a rate of 12.3% over the last 10 years. They had a smaller hike here recently, but that's no issue whatsoever. They had this spike here in shares outstanding, but that's because they made an acquisition. If you take a look here at the quarterly, they have already been chopping at that share count. So they was at 339 million shares. They're already down to 319. So they've bought back 20 million shares already. And I'm just assuming they're still just chopping at it. So take a look at the return on capital employed. That's going to be down because they had to issue back more shares. But if you take a look over history, this thing hovers around 30%, 40%. And that is just ridiculous because most of the time, your companies are around 10%. The gross margin is silly, 70%. The operating margin usually hovers in the 40s and 50s. Profit margin, high 20s, 30s. It's silly. This company knows how to make money, and they do it very well. Next up's Home Depot. I really like Home Depot. I like Home Depot more than Lowe's. The reason being is their debt situation's a lot more controlled than what Lowe's is. Lowe's has a bit more debt to EBITDA ratio. Free cash flow is 5.4%. Dividend is 2.8%, and the payout ratio is right at 51%. They're off their recent high of around 330, so they're down a little over 10%. Revenue's been increasing at a rate of 7.73% over the last 10 years. The free cash flow has been increasing at a rate of 7.34% over the last 10 years. EPS, just look at that. That's silly. 18.72% over the last 10 years. Their debt, as I was saying, $41 billion. Their EBITDA is $27 billion. Again, nowhere near the 3-time ratio. The dividend, 18.28% dividend growth over the last 10 years. And their last hike, I think, was 10%. So, very nice. Shares outstanding, 3.81% over the last 10 years. They're just shopping at this ever so quickly. That's a pretty quick share buyback there. And again, you want your company to do share buybacks if they got that extra capital set in there, because that gives you more and more of the company. Your share counts as more. And return on capital employed, it's pretty much been above 30 for forever and a day. Gross margins, 30% area, it's very good. Operating margins, mid-teens, pretty good. Profit margins are growing and cracked above 10%. So yeah, a lot of great things from Home Depot. I like them. I know a lot of people are afraid of it right now because of the housing market issues and everything going on with that. But again, this is a long play. You're not buying Home Depot to get rich tomorrow. Plant that seed and let it grow into a tree. That is what I'm saying. Now, next up, we got McDonald's. This is the one exception to the rule, my debt rule that I was telling you about. I will show you that here shortly. So McDonald's was trying to crack that 300 mark down to 255, so we're down almost $45 off their recent high. Let's take a look here. Adjusted free cash flow yield 3.47%, dividend yield 2.39%, payout ratio 54.8%. The revenue has been kind of flat-ish, but they're picking things back up again. 2020 hit, but they're looking like they're right back on track. Free cash flow has been increased at a rate of 8.22% over the last 5 years. EPS right at 5%, 4.5% over the last 10 years, slowly and steadily going up. Now they do have some debt at $35 billion. Their EBITDA is 9.7. So it's a little bit more. It's like 3.5 times. But they've got such a big moat. It's McDonald's. They know what they're doing. And if you take a look here, they've not been really paying it off too much. Hopefully this is something that they start chopping at. I know interest rates and stuff are a big issue right now for a lot of companies. The big thing with McDonald's, they just announced a 10% dividend hike, just came out. So now paying $167 a share. That dividend's been increasing at a rate of 8% over the last 10 years. So that is some strong compounding yet again. Shares outstanding. They were buying back some shares pretty aggressively through here, and it looks like it's kind of tapered off the last couple of years, which is okay. And the payout, return on capital employed, the 2020, they dipped down to 15.77, but it's right back at the 20 mark. They usually hover in the 20s, mid-20 area. Gross margins are ridiculous, right at 50% area. Operating margins, we are looking at very high in the 40% area. And the profit margins, same thing, mid to upper 20s. Just great company. I like all of these. Especially have my eyes on McDonald's since it's dipped down some here. They have been on what was a run, but now they've got that big dip. If this thing keeps dropping, because back in October was the last big low that we had in the market. This thing hit 230 back in October. And I'll be honest, I wouldn't mind holding this at 255. I like this. I like all of these. So that's my problem right now. There are so many things on sale that I don't know what I want to do with my capital when I do get it. But it's not a bad problem to have. There's a lot of red out there. There's a lot of things on sale. Again, always do your own research and stuff before buying anything. But yeah, hit that like button. Subscribe for more. And until next time, see yous.